Drenad Trust here. We love dividends here, right? We love dividends. What will we do without dividends, right? We know the risks, but we want our money back and then some, right? So these, key three tech stocks are ones that you're going to want to invest in right now because they have a history of consistently increasing dividends. So several technology companies stand out, for their reliable and steadily growing dividend payments. So the key examples are these three, right? We have International Business Machine. So IBM has increased its dividend for 28 consecutive years. The most recent dividend hike was in April 2024, raising the quarterly payout to $1.67 per share, which is about $6.68 annually with a yield of 3.95%, right? 3.95%. The next stock we have is Cisco Systems. So Cisco has paid dividends for 14 years and increased them for 13 consecutive years. In February 2024, Cisco raised its quarterly dividend by 2.6% to 40 cents per share, which is about $1.60 annually, yielding 3.51%. The next stock we have is Hewlett Packard Enterprise. HPE has maintained dividend payments for a decade with regular increases. So the current dividend is about 13 cents per share quarterly, which is about 52 cents annually, yielding 2.49%. So the technology sector overall has shown strong trend of dividend growth, with dividends growing at a compound annual rate of over 16% since 2011, far outpacing other S&P sectors. So while other sectors have longer standing dividend kings, right, companies with 50 plus years of consecutive dividend increases, the tech sector's longest streaks are generally shorter due to the industry's historical focus on growth over income. So these tech stocks have a very strong history, right? But there are risks. I don't want to only give you the good. We want to make sound decisions. So dividend sustainability and financial distress. So a high dividend yield can be a red flag rather than a sign of strength. So often yields spike because of a company's share price that has fallen, potentially due to financial troubles or declining business prospects. In such cases, the high yield may not last, as companies under pressure may reduce or eliminate dividends to conserve cash. Investors should scrutinize a company's financial health, including free cash flow and payout ratios, right, to assess whether dividends are sustainable. There are dividend cuts and volatility, so dividends are not guaranteed. Even companies with a history of stable payouts can cut or suspend dividends during economic downturns or sector-specific crises, right? The tech downturn in 2022 is a recent example where concentration in dividend stocks led to significant losses. So tech companies paying high dividends may be signaling a lack of growth opportunities. Instead of reinvesting profits to fuel innovation and expansion, they may return excess cash to shareholders, potentially slowing long-term growth. High payout ratios can indicate that a company is prioritizing dividends over necessary investments, which may hurt future competitiveness, right? Dividend stocks, including those in techs, can become less attractive when interest rates rise, as fixed income alternatives offer better risk adjustment returns. This can put downward pressure on share price. So focusing heavily on high yield tech stocks can expose investors to concentration risks. If the tech sector underperforms, portfolios heavily weighted in those stocks may suffer disproportionately. So yields above 5 to 6% are considered risky by analysts, as the probability of a dividend cut increases sharply beyond this threshold. Exceptionally high yields often result from sharp share price drops, not from sustainable business performance. So moving on, well-known, giants like Nvidia, Microsoft, and Apple continue to dominate headlines, obviously, right? Several lesser known tech stocks have, delivered underneath the table and they've delivered strong performance in 2025, right? Thus far. So I also believe that you should look into that as well instead of the popular ones, right? So they have a lot of these stocks that I'm about to name. They're not household staples, but have shown notable growth and momentum this year. So we have Super Microcomputer, right? So it basically, this company specializes in, high performance server and storage solutions, particularly benefiting from the AI and data center boom. So it delivered a 35.7% gain in, as of 2025 with robust revenue, 20.44%, and earnings growth, 29.79% rates. It's recognized for its modular open architecture systems, making it a key player in the AI infrastructure space. We have Innodata, right? INOD, which focuses on data engineering and AI services, helping enterprises manage and leverage large data sets. It's listed among the fastest growing tech stocks to watch in 2025, with strong momentum in digital transformation services. We have Red Cat Holdings is next. So this operates in drone technology and unmanned systems, serving both commercial and defense applications. It has been identified as a tech stock with significant momentum, reflecting investor interest in emerging defense stock. We have BitFuFu Inc., which is a digital asset mining and cloud-based mining services provider. It achieved an extraordinary earnings surge of over 4,000% and is expanding through strategic acquisitions and proprietary mining OS development. So market capitalization, remains modest as around, 726 million, keeping it under the radar compared to larger tech firms. We have Lumentum Holdings, so it basically supplies optical and photonic products for networking and laser applications. It demonstrated strong earnings growth, 119.67%, and is well positioned in the expanding optical communications market. We have, Clen Inc., though more is basically biotech oriented. This company leverages advanced nanotechnology and has posted impressive revenue at around 60.86% and earnings of around 63.07% growth, representing the intersection of tech and healthcare innovation. So this is kind of like a 2-for-1, that is really good to take advantage of. So these companies, again, they're not widely recognized as tech giants, but have outperformed many larger peers in 2025. Their growth is driven by exposure to high demand sectors such as AI infrastructure, digital transformation, advanced networking, and emerging tech niches like digital mining and drone technology. So investors seeking high growth, lesser known tech stocks should, consider these names for further research, keeping in mind these higher volatility and risk associated with smaller cap stocks. Okay, so that's something to keep in mind. So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you gained value from this video and you want more videos like this, please let me know that by hitting that subscribe button and that like button. Also, let me know your opinions in the comment section below. I appreciate your viewership. Stay safe and see you on the next video.